How Warren Buffett thinks about risk, uncertainty, and loss. Imagine you buy a stock for $100. A few months later, the price falls to $70. Most investors immediately think, I just lost 30%. But Warren Buffett might ask a completely different question. Did the investment become 30% worse, or did the price simply change? That distinction reveals something fascinating about how Buffett thinks about risk. For most people, risk feels like movement. A falling stock feels dangerous. A rising stock feels safe. Buffett sees it differently. To him, the real danger isn't necessarily watching your investment fall temporarily. The real danger is suffering a permanent loss of capital. And those two things are not the same. Think about two businesses. The first is an excellent company with strong economics, little debt, and a product people will probably continue buying for decades. Its stock falls 40% because investors suddenly become pessimistic. The second looks exciting. Its stock keeps rising. Everyone is talking about it, and investors feel confident. But the business depends heavily on debt, has weak economics, and you don't really understand how it makes money. Which one is actually riskier? The first may be experiencing enormous volatility. The second may be carrying enormous risk. This is one of Buffett's most important mental shifts. Price volatility and investment risk are not automatically the same thing. But there's another distinction that makes his philosophy even more interesting. Buffett is not afraid of uncertainty. He is afraid of not knowing what he is doing. Those sound similar, but they're radically different. You can invest in a wonderful business and still have no idea what its stock will do next year. That's uncertainty. But if you don't understand the business, don't understand its economics, don't know what could destroy its competitive advantage, and you're buying simply because everyone else is excited, that's ignorance. And ignorance is much harder to protect yourself from. Imagine driving through thick fog. You may not know exactly what is 20 miles ahead. That's uncertainty. But if you don't know how to drive, don't know where the road is, and cannot see the dashboard, you're facing something much more serious. The problem isn't simply that the future is unknown. The problem is that you don't understand the situation you're in. This is why Buffett has repeatedly emphasized staying within what he calls his circle of competence. He doesn't need to know everything. He needs to know what he doesn't know. And that is an incredibly powerful investment skill. Because when investors experience fear, they often make the wrong decision for the wrong reason. A stock falls and they panic. A stock rises and they become confident. But Buffett's question is deeper. What has actually changed? Has the company's earning power deteriorated? Has its competitive advantage disappeared? Has management made a terrible decision? Has the balance sheet become dangerous? Or did investors simply change their minds about what the business is worth? That question can completely change how you respond to a market crash. But Buffett's philosophy doesn't mean you should blindly buy every falling stock. A falling price can represent opportunity. It can also be a warning. The difference is understanding. And that's perhaps the most uncomfortable lesson. You cannot eliminate uncertainty from investing. You cannot predict every recession, crisis, technological disruption, or market crash. But you can reduce the number of ways in which you can permanently destroy your capital. You can avoid excessive debt. You can avoid businesses you don't understand. You can demand a sensible price. You can build a margin of safety. And most importantly, you can develop the discipline to admit, I don't know. Because sometimes the smartest investment decision isn't buying. It's walking away from something you cannot understand. That's the deeper Buffett lesson about risk. The goal isn't to build a portfolio that never falls. The goal is to build a decision-making process that can survive being wrong. Markets will surprise you. Businesses will disappoint you. Prices will collapse. Predictions will fail. But if you understand what you own, know the limits of your knowledge, and protect yourself from permanent loss, uncertainty becomes something you can live with. And perhaps that's the real secret. Buffett didn't become successful because he could predict the future. He became successful by refusing to bet his future on the things he couldn't understand.